Good afternoon. We'll get started. A few more people might be rolling in, but at least we have a lot of content to cover, so this will allow us to hopefully get through all of it. I want to thank you all for joining today, this afternoon, for this joint presentation between the Bonadio Group and WMHT. Hopefully you'll walk away with some good tidbits of information to help you in your own personal situations. We also hope that you and your families are healthy and doing okay, holding up all right through all this craziness. Hopefully we'll get some normalcy sometime soon. So you can see the first slide is a housekeeping slide. It has some tips on connecting your audio. And if you have any technical issues, please be sure to put that in the chat and our host will assist you. Don't do it to the instructors directly in the chat. And as far as the chat, if you hold your mouse over the bottom of the window of the screen, you'll see a bubble there that will pop up. That's the chat, to open the chat window so that if you do have any questions or issues, you can submit those. We are looking to address questions towards the end. So if you could put your technical questions in the chat window to all panelists, that will allow us to respond. We will try to leave time at the end. If for some reason we don't get to your questions, we will try to respond afterward. We'll follow up by email to do our best to get your questions answered. So all participants will also get a copy of the recording after this session, as well as another copy of the slides. Some people may already have downloaded the PowerPoint, but for those that haven't, a copy will come by email after the presentation. And again, you'll have a copy of the recording in case there's something you want to listen to again or forward it on to anybody. Please feel free. With that, I want to introduce Robert Altman, who is the President and CEO of WMHT, so he can say a few words. Robert?
Thank you, Cindy, and thank all of you for joining us today. Thanks in particular to the Bonadio Group. They've been great friends to WMHT Public Media in many of our business planning, so I'm happy to have them here today to help us with some of our planning in our own lives. And then I also want to thank the members of WMHT, our supporters, many of whom are on the call today. Everything that we do is, of course, made possible by their support. I know there are a lot of folks on the call from elsewhere in upstate outside the capital region. And for those of you who are in other places in Binghamton or Syracuse or Plattsburgh or Watertown or Buffalo or Rochester, great public television stations there as well, and I hope you're supporting them. Thanks. Enjoy the show.
Thank you, Robert. So my name is Cindy Tarofsky. I am managing member of Bonadio Wealth Advisors. That is the statewide financial planning division in the Bonadio Group. And there, just for a little background, our CPA financial planners, we advise business owners, executives, other individuals on their overall personal finances. We're a little bit unique in that we can provide high caliber tax and financial planning expertise that comes from our time and advanced training being focused solely on planning and consulting. We don't manage money. There is a division in the group that does that for those that want it, but our focus is strictly on planning and consulting. So that allows us to bring more information to you so you can make more fully informed decisions that affect your finances. A lot of content, as I said, to cover today. Oops, bear with me. Sorry about that. Before we get started, we wanted to just get a sense of, there's a polling question that you can see up here that we want to get a little sense of what your concerns might be, whether it's estate planning, retirement planning, both. Maybe you're not sure. If you can just submit your response, and then we can just get a sense. Make this a little interactive. We miss being able to do this in person. Okay, we'll give it a couple more minutes. Bear with me for a second. Okay, I'll close the poll. Let's see what the responses are. So we have a mix of certainly some concern about both retirement planning and estate planning. This content will cover a little bit of both, so I think that you'll get some input that will help give you some information for that on both topics. So in the last 6 months, so much has changed. We've had 2 big tax law changes, and those have significant implications on retirement accounts, your estate plan, your tax planning, and then of course we have this pandemic. That's affected the economy, our health, our finances, the stock markets, etc. But what we want to talk about today is the 2 tax law changes, and we'll go into more detail, and then we'll talk about some planning opportunities that arise due to this environment that we're in. So a couple key takeaways from both of these tax law changes. The SECURE Act was passed in December 2019 before all this hit, and it has significant impact on inherited IRAs. And those changes may lead you to, consider whether you want to change who your beneficiary does, who you name as beneficiaries on your retirement accounts, life insurance, IRAs, if you have annuities, etc. And maybe even cause you to want to revamp your estate plan. It also might add more consideration for doing Roth IRA conversions. There already always was that, but this might even be more of an opportune time to at least consider that. And then the CARES Act, that came up in this past March, of course, during this whole thing. So that is geared towards helping us through these times, should the need arise. So for those that have their finances negatively impacted, the qualified retirement plans and IRAs now allow for penalty-free distributions if they're COVID-19 related, and also waived the required minimum distributions for 2020. Also provided some charitable giving tax changes that we'll go into more detail on. So the SECURE Act, let's cover that first. Setting every community up for retirement enhancement. This was to provide ways to help everyone save more for retirement, better provide for themselves for retirement. So some of those changes, the traditional IRA contributions used to have an age 70 and a half cutoff point where you couldn't contribute any further. That has now been lifted. There's no age limit. So as long as you're still working and have earned income, starting in the year 2020 tax year, you can now continue, you can make IRA contributions if you have enough earned income to cover that. Required minimum distributions used to start at age 70 and a half. That's the idea that retirement accounts aren't meant to be kept in tax-deferred wrapper forever. We have to start taking those distributions out. They have now extended that age to age 72. And it's nice that it's a nice round number instead of 70 and a half. So that starts for 2020 or later. And then there's qualified charitable distributions, some changes to that. That's been tied to age 70 and a half, and it used to be tied to the time also when you start to take those required minimum distributions. That age has stayed the same. So though the required minimum distribution age has gone up to 72, the QCD, as we call it, is still, you're still eligible once you reach the age 70 and a half. And that's allowing you to donate up to $100,000 directly from your IRA or inherited IRA to charity. There is now, though, because we talked about the fact you can still make traditional IRA contributions past age 70 and a half, those have to be, you have to reduce your qualified charitable distribution by those contributions if you do make contributions past age 70 and a half. There's actually a whole worksheet that has to be filled out to figure out how much of that would be, how much the reduction would be. One of the biggest changes, as I indicated before, is to inherited retirement accounts. This has significant implications. So what's new? Most non-spouse beneficiaries must fully distribute the inherited account within 10 years. This is for deaths of account holders in year 2020 or later. So if somebody died in 2019 or before and you inherit that account, you still have the old way of figuring out what those distributions would be. And what those were is both all for inherited IRAs, Roth IRAs, and qualified plans. The distributions were you could take them over the life expectancy of the designated beneficiary. So that was when the beneficiary was an individual or certain trust. We call it a qualified trust that qualifies as a beneficiary. And in that case, those were stretched over a much longer time period. So with this tax law, 10 years, that has really accelerates it for most accounts. There are some exceptions to that. They're called eligible designated beneficiaries, EDBs. They are not subject to the 10-year rule. So they still get the distributions over the life expectancy. Those eligible designated beneficiaries include the surviving spouse, minor children of the deceased account owner, so not grandchildren, et cetera. It's strictly the minor children of the account owner, disabled or chronically ill individuals, and individuals not more than 10 years younger than the account owner, so it comes to mind as siblings. For a minor child, they become subject to that 10-year rule once they are at the age of majority, and once the eligible designated beneficiary passes away, the account then is subject to the 10-year rule. Sometimes we might have trusts as beneficiary of retirement accounts, and those are also subject to the 10-year rule, certain trusts, I should say. So where they're named as beneficiary in retirement account, you have to be aware that that distribution time period could be accelerated for that beneficiary as well. And there's reasons that we might name a trust as a beneficiary. It could be to save estate taxes, usually state estate taxes. Federal has what we call portability, but it's possible that one of your spouses used up their exemption. So it could be also to save federal estate taxes. It could be to protect a beneficiary from depleting it faster than the required minimum distributions. If they inherit it directly themselves, they could take out more than the required minimum distribution. This having a trustee in the mix can avoid that. It also can be to control the disposition of the remainder. So maybe you want the spouse to receive the distributions for lifetime, the remainder to go to children from a prior marriage. That might be an example. So there's reasons to name trusts, but now there's implications. Now these trusts can be structured in different ways that are named as beneficiary. It could be where the IRA, either way, the distributions from the retirement account would come into the trust. It's a question of the design of the trust as to what happens to those distributions once the trust receives them. It could be that the trust accumulates those distributions, and then it goes to the terms of the trust as to how much actually goes out to the trust beneficiary. Maybe it's your children or something. And very likely most or all of those IRA distributions would be taxed in the trust at the trust tax rates, which are high. You reach the top trust income tax rate at around $13,000, whereas for a married couple, it's over $600,000 before you hit that top tax bracket. Or the trust might be structured to get the distribution and pass it right out to the trust beneficiary. That's called a conduit trust. And that's great that the amount is not being kept in the trust and that the trust tax implications pass on to the beneficiary who receives the cash. But again, the beneficiary is receiving the cash. So all the reasons that you might set up a trust and have it be a beneficiary of your retirement account, this might foil that whole thing. So that's a really, really big issue. So now when you look at whether the trust is paying the tax, beneficiary is paying the tax, significantly faster, larger distributions, and certainly accelerated income tax implications. So this might make your estate plan not work the way you intended it to work. So what this all might bring you to do is review your overall estate plan holistically. You know, you don't want to have undesirable, unintended results. When we say overall estate plan, it's not just your legal documents, understanding the titling, because what's the ownership? That will dictate whose will or trust that your assets flow through to, and follow the terms of your will, funding any trusts that are formed in your will. It's also the beneficiary designations. So it's the documents, it's the structure of your finances, and it's the beneficiary designations. How does that all come together? You might, when you look at all that, reconsider which assets go to who. It might be that you want to name charity for some, or you want to change which of your heirs get which assets. You might want to change the timing, knowing now what you know. Income tax implications for both you and your heirs and beneficiaries have to be considered as well, and sometimes that's a bigger implication than the estate tax. Gift and estate tax implications always need to be considered when you're reviewing the estate plan. And always keep in mind that charitable gift strategies sometimes leave more money in the pot to work with, and because there's no income tax when you have a charity, when you're working with a charity because of the tax-free status. So there could be more going to, at least the same or more going to heirs, while you're also fulfilling the philanthropic priorities that you might have. So keep that in mind. Don't rule them out. So we talked about the eligible designated beneficiaries. So now the impact on those non-eligible designated beneficiaries that do get the 10-year rule. We indicated that's faster distributions, which not only accelerate the cash coming out sooner, but also accelerate the income tax implications. Picture you have a $2 million IRA, and now that's a lot of money coming out maybe to a child in 10 years than you wanted them to have in that time period. Now, also know that Roth IRAs fall under that same 10-year rule, but by nature, they're tax-free. So your beneficiaries might still get the cash faster than you want them to, but at least they won't bear that accelerated tax burden that a regular traditional IRA or retirement account has. So if you've named a trust as beneficiary, you might want to revisit how that is structured. If it's formed in your will, or maybe you have a revocable trust, now you understand there's cash flow and tax considerations that might need to be revisited. Who should receive your retirement accounts? If you have charitable inclinations, maybe instead of a bequest to charity in your documents, you have, or instead maybe you name charity as beneficiary on your retirement account. Another consideration is possibly a charitable remainder trust to be beneficiary of a retirement account. It might kind of put back that stretch time period for amounts coming out and going to beneficiaries, and stretch out that income tax implication as well, all the while you're benefiting charity. You might, during your accumulation years, want to consider Roth IRAs, Roth 401ks if you have those options, and possibly a Roth IRA conversion. Let's talk about that Roth IRA conversion. When you have a traditional IRA or a regular qualified plan, you've gotten tax advantages as the money's gone in. So when you convert that to a Roth IRA, that tax payment still has to be made. So when you convert, the value as of the time of conversion gets treated as taxable income. So you can do a full conversion, partial conversion, but from that point on, qualified withdrawals come out tax-free. So you've basically frozen it for income tax purposes. The fact that values in most people's investment accounts are down, those deflated values minimize the impact of conversion. So that value is lower that now is recognized as income on your tax return. So at some point, markets will get back up to where they were and higher. Let that rebound happen in a tax-free Roth IRA. Also, for some people, 2020 taxable income might be lower. And then also back in 2017, we had a tax law change that reduced tax rates, income tax rates, but it's temporary. That sunsets 12/31/2025. So might as well consider taking advantage of the fact that we have these low income tax rates right now before they bounce back up, or it could be sooner, especially with all the spending the government's having to do right now. So for a younger person, a conversion can make sense for income tax purposes, and There's no required minimum distributions on Roth IRAs, which can be a nice advantage. And for those with excess wealth, this is money you're not expecting to need for your lifetime. It can be a very effective vehicle to pass on to your heirs. For one, like I mentioned, no required minimum distributions over your lifetime, so that Roth IRA is allowed to stay intact, compounding, tax-free. Distributions coming out to your heirs once they inherit the account continue tax-free. And again, they still fall under the 10-year rule. And payment of that conversion tax reduces your taxable estate. So basically, you're paying the income tax for your heirs, because if they inherit a traditional IRA, they'd have to pay the income tax on anything they take out as distributions. You're paying it for them. So it's like another gift without it being subject to gift tax. So a little extra leverage there. The other tax law change, the CARES Act. So this one has a lot of retirement account provisions. I'm only covering the ones that are at the individual level. There are also plan level. If you're an employer that has a qualified plan, there's articles on our website that cover considerations at that level as well as articles that cover the individual perspectives too. So some of the main provisions there is that should there need to be distributions taken because of COVID-19 related issues, you can avoid the 10% premature penalty if you're under age 59 and a half. And that's on up to $100,000 of distributions in 2020. Certain individuals qualify for this. It has to be that you or your spouse or dependents are diagnosed with COVID-19, or there's financial consequences directly relating to it, and those are listed there. Of course, I discourage it unless it's absolutely necessary and it's the only pot to turn to. So, because we still have retirement to be prepared for, but certainly understandable if it's dire financial situation. So those should there need to be a distribution, that would be including taxable income spread over 3 tax years, unless you elect not to for some reason. You want to have it all taxed up front. The distribution can also be recontributed back into any IRA or qualified plan that accepts rollovers if it's done within 3 years of when you take the distribution. You can do it all in year 3 even. And if you chose to spread that income over the 3 years, you would go back and amend those prior year's tax returns to take that distribution out of income. At the employer level, should you need a loan, you're in a qualified plan, a 401k, profit sharing, et cetera, and you need to take a loan as one of those pots to turn to, the limits have been raised on how much you can take, and also any loan payments, even if you had a balance in March from a prior loan, are given an additional year for repayment. So that can really help alleviate the strain financially. Employers can choose if they want to amend their plans for these provisions, but at the individual level, the 10% penalty would still be waived. Another provision was that the 2019 IRA contributions got extended to July 15th. That gives a little more time to make contributions. And they waived the 2020 required minimum distributions from retirement accounts. Now, some people had already taken those distributions. They can be rolled over if it's only been 60 days since you received the distribution, and it has to be that you didn't already do another one of these rollovers in the last 12 months. So you can roll it back into a plan if you're eligible under those circumstances. And also on a charitable note, though those required minimum distributions have been waived for 2020, know that the qualified charitable distributions still, all those tax benefits still remain intact. So let's talk more about that. I hinted to it a little bit earlier, but for those that aren't aware, this has been around for a few years. Years ago, they kept sunsetting it and then re-extending it, so now it's permanent. So a qualified charitable distribution has all kinds of tax advantages, charitable advantages. So you can donate up to $100,000 to charity directly from your IRA or your inherited IRA if you're at least age 70 and a half at the time that you want to take this withdrawal. this distribution. It can't be in the year you turn 70 and a half. It has to be you already turned 70 and a half, and now you're going to take this distribution. You can't receive the distribution personally. It has to go directly from the institution to the charity. It has a lot of benefits, even if you don't itemize your deductions, which under the current tax law, a lot more people are not itemizing. The standard deduction is higher than their itemized deductions, so they wouldn't otherwise get a charitable deduction from any contributions they make. The tax benefit is that you don't have to report the distribution in your income. So right there, you get a tax savings just by not having to report that income. Another advantage is it keeps your adjusted gross income and your taxable income down by not reporting that income. And those two thresholds have implications for other things, such as how much of your Social Security benefits are taxable. Some things are based on the AGI floors, your tax brackets. There's a thing called QBI that is impacted by the taxable income. So the distribution can only come from taxable amounts. I've had people ask me if it can come from a Roth IRA. It would only if it was that if you took a distribution from the Roth IRA, it was taxable. So this would be in case where you didn't hold it for 5 years and you were taking out earnings. And it also cannot be from an ongoing SEP or simple IRA plan. Ongoing meaning the employer is continuing to make contributions. Once it's dormant in a sense, it becomes treated like a regular IRA, and then you can use that pot to make these distributions. It can satisfy the required minimum distribution, which doesn't apply for 2020, but likely, who knows, next year, but in the future years, it can satisfy that required minimum distribution if you don't need it for yourself. It also can satisfy a pledge. Now, but there can be no quid pro quo, meaning, I can't say it, quid pro quo, meaning you don't get anything back for it. So you can't have a benefit. It must fully qualify as a charitable contribution. So for WMHT supporters, that means you can't receive a thank you gift, but you can receive the WMHT Passport Streaming membership. So keep that in mind. Now, these distributions, these QCDs, cannot be made to a donor-advised fund or a private foundation. It has to be a regular public charity. The CARES Act, so Coronavirus Aid, Relief, and Economic Security. I always wonder how they come up with the names on some of these. That provided, continuing on with it, that provided more charitable provisions for cash donations made to public charities. So for those that take the standard deduction that don't itemize, there's a new $300 above the line charitable deduction. So that reduces your adjusted gross income. And for those that do itemize, if you're looking to make larger contributions or your AGI is down, you used to have a limit of up to 60% of your adjusted gross income, but now the contribution could be up to 100% of your adjusted gross income for 2020. And for each of these donations to private foundations, supporting organizations, and donor-advised funds are not eligible. So we have another polling question, just out of curiosity here. Let's make this interactive. Okay. So are estate taxes a concern? Maybe federal and state estate taxes, maybe just state estate taxes due to the high federal exemption or exclusion that we have, maybe neither, maybe you're not even sure, but let's just get a little perspective that'll help dictate some of the discussions. Given another 30 seconds. Okay. Well, we have a good portion are saying that federal and state estate taxes are a concern, and that's still some concern in the estate taxes or neither. Good input. So we'll talk a little bit more about some ideas along those lines to help you to save some estate taxes, whether it's federal or state. So we talked a little bit about how this pandemic has certainly caused havoc on finances. We look at the stock market is certainly a roller coaster ride right now as the emotions are even worse. So values are down overall. Businesses, likely valuations are down in businesses as well. Not some businesses, some are thriving under this environment, but for many, the value of the businesses are probably down. Real estate values, probably more so commercial at this time, are either down or on the decline or maybe will be. And we have low interest rates on savings accounts and bonds. They were already low, but they're going lower, which hurts on that side of things. And I think you can understand that charity certainly needs your support now more than ever. So please keep them in mind if you're in the financial position to do so. So this isn't all bad news. Those deflated values we talked about, those low interest rates, all creates combined a perfect gifting environment. We have a high federal estate and gift exclusion, $11.58 million right now per person. So about $23 million for a married couple. For those that are New York residents, we have no New York gift tax. You have to check your own state rules if you're not a New York resident. So wealth can be effectively removed from your estate if you live at least 3 years for New York's purposes. And also we have an arsenal of techniques still available to us. There's been discussions over the years about restricting those or eliminating some of them. And same with the valuation discounts, they're still in full force. There's also been discussions and proposals to reduce the effectiveness of those, but that's not an issue yet. With all the budget, the federal budget, who knows if that will continue to be the case. So you can see all these factors really create a wonderful environment for gifting if you're in the position to do so. And for those that own a business, now is a great time to, because of these things, dig into your succession planning and see what makes sense for your situation. But before anybody does any planning, as with any planning, it's not just about the techniques. I did a prior webinar. Those are tools in a toolbox. You always have to know which tool to use for the situation, right? And if you think of all the different kinds of screwdrivers, be proud of me, Phillips head, I don't know, standard one. You have to know the right tool and the right design of that tool. So you need to step back, so do the planning in a vacuum, and consider the other aspects of your situation so that you can decide on what technique is the most suitable for you and how it should be designed for your situation. So when you're talking to your friends and family and neighbors and you're at a cocktail party, when we can do that again, they might say, oh, I did this, or I used this technique, or whatever worked great. Well, again, it might be a good technique for your situation, but maybe it needs to be designed differently for your circumstances. So in doing so, you want to consider your cash position and your cash flow needs, your own financial security. You got to make sure you keep enough for yourself. What's your core capital? How much is extra or excess? You have to understand your income tax and the gift and estate tax implications. You also have to do the same, understand the same for your heirs, their financial and income tax situation, your philanthropic goals. And if the planning involves the business, the strategy needs to work for the business as much as it does need to work for you individually. So again, both from a cash and income tax perspective. So one of the first techniques I want to talk about is charitable gift annuity. So the way this works is you transfer cash or property, it could be publicly traded securities that you have maybe you have a gain built in on it. Maybe you bought it a long, long time ago. And you donate that to charity in exchange for fixed payments for your life or over the joint life, maybe you and your spouse. You get a charitable income tax deduction for the remainder that is calculated to be passing to charity. And as you receive those payments, some of them, part of the payments might be tax-free. It depends on what assets you donate. You don't need to redo your wills or form trusts to leave money to charity and to reduce your taxable estate. So in this pandemic, hopefully the health scares are coming down a little bit, but this is something that can be a quick emergency, reduce the estate if there's a bad situation without it taking much time. It's simple. It can be established quickly and for a lower investment than for a trust. So for WMHT, the minimum is $10,000. You wouldn't form a trust and fund it with $10,000. And a big important note here is that, as we said, interest rates are coming down. That's going to affect these as well. So rates are going down on these effective July 1st. So it will result in lower annuity payments than gifts made before June 30th. So if you're considering this, I would urge you to jump on that so that you can get larger payments back over your lifetime. Another opportunity is to take advantage of the enhanced gifting leverage we currently have. If you have a federal taxable estate, you have an opportunity to lock in that temporary $11.58 million federal exclusion that we currently have. Under the 2017 tax law that was put in place, raised to that level. It was around, a little over $5 million before. That is set to sunset 12/31/25 or sooner. So nobody has to take any action at 12/31/25. That goes away. Congress doesn't have to pass a law. No action, no political fallout, etc. But very possibly that's going to go away even sooner. We think of all this federal spending with the budget that we're having. So we have 2 elections in the meantime. It's very possible that this opportunity will go away. Because we have this big federal taxable estate and these values down, you can transfer more units for the same gift value. So you let the rebound happen in the hands of your heirs. If you have a state, taxable estate, but not federal, it could be that you want to make the same gift, but now it's at a lower value, which preserves more of your federal exclusion to have for other gifts in the future or for your own estate. Now, as I mentioned, New York doesn't have a gift tax. You have to live at least 3 years for that asset to be effectively removed from your estate. But either way, the growth is still removed. So if there's a rebound, that still has an advantage. How might you do this gifting? You can always gift outright, right to your heirs for them to do whatever they want with. Certainly that's the simplest. You might want to gift in trust. There's lots of tax and non-tax reasons to gift to heirs in trust rather than outright. It could be asset protection is a big one, divorce, creditors, etc. We're in a lawsuit-happy world. It could be you don't want them to have too much money too soon. Lots of different reasons. But when you're doing this, you do need to consider the income tax implications to heirs. When you select the assets to gift, carryover basis applies when you gift, meaning whatever it was in your hands, it is in their hands. So when they later do sell the asset, that impacts the capital gain they will recognize. If it stays in your estate, so it gets a step up in basis. So when you're gifting, you might want to choose higher basis assets and leave the lower basis assets in your estate if that's possible. If you want to gift to an irrevocable trust for the reasons, all the different reasons there are for gifting in trust, the deflated values that we currently have will reduce the gift tax impact as you make that gift to the trust, or it might allow you to gift more units to the trust. The trust can be structured to pay the income tax itself on any income it earns, interest, dividends, capital gains, or you as the grantor might pay the income tax. And if you do, the trust is left intact to grow and compound free of taxes, and any income tax cash money you use to pay the tax on the trust income further reduces your estate without it being a gift. So we call that estate burn. So that's a potential advantage that outright gifts don't have. So if you're really looking to have remove significant wealth from your estate, especially if you have a federal taxable estate, that can be a powerful strategy. Any gifts remove future appreciation from your estate. So someday we will have appreciation. And you get the benefit of seeing them use the assets, benefit from them while you're alive, the benefit of lifetime gifting. So another technique, a sale to an intentionally defective grantor trust. Maybe instead of doing a full gift to a trust, the way like we talked about in the prior slide, maybe you want to just do a partial gift. You need to give it a little bit, seed money it's called, And maybe you want to sell some of your assets to the trust and take back a note if that fits your situation. Maybe you want the cash, you need the cash back. So with this strategy, the fact that we have these low values, it reduces the portion that needs to be gifted into the trust to provide the funding to make this all legitimate to pay the note payments back. And also the low interest rate on the note reduces the interest, the minimum interest that you have to charge, that the trust would have to pay you if that's an objective. Again, it's a minimum. You can always charge more interest. But if you want some payments back, but they don't need to be the maximum, the fact that the interest rates are so low means less is coming back into your estate and more of the trust is left intact to compound. This is an estate freeze technique. We say that because any amount of the note payments that you don't spend are still in your estate, but any appreciation is removed. So not only the unspent note payments, but the balance of the note is still includable in your estate. But again, any future appreciation is removed. That can still be pretty powerful. Another technique that's perfect for this environment is a charitable lead annuity trust. So in this one, you make a gift to a trust. The trust pays charity an annual payment, and at the end of the term, the assets remaining in the trust pass on to your heirs. It could be that you are already making charitable gifts every year. So what this would do would leverage those annual charitable gifts you're already making and create a discount for the amount that ultimately will pass to your heirs. The amount that we calculate would ultimately pass to your heirs is a gift, subject to gift tax. So the fact that values are down, interest rates are down, reduces that amount, the amount of the gift portion. And the fact that charity gets use of the money and your heirs don't get it right away is the starting point for this discount. So there's a discount anyway, but then the fact that the values are down, interest rates are down, further adds to this strategy, timing-wise. A sidebar is that when the 2017 tax law came about and raised that standard deduction so high, and again, many people are not itemizing, so you make a charitable contribution and you don't get a deduction for it, nothing extra. You're still getting the standard deduction. With this strategy, by the amount that you put into the trust, you carve off some portion of your portfolio and put it in this trust. You're making this gift to the trust. You no longer will have the interest and the dividends and the capital gains on your personal tax return that you would have otherwise had. So you're saving income tax just from that standpoint. Then the trust is making the charitable contributions for you that you would have been making. And that can offset, can be structured to offset, or mostly offset, hopefully fully offset, the interest, dividends, et cetera, that the trust is realizing. So you can shelter that income by the charitable contributions, remove it from your personal tax return, and voila, you have a tax savings from these charitable contributions being made each year by the trust. Another technique is intra-family loans. So with this, you make a loan to whoever you'd like, typically family members, friends, I guess. So the IRS stipulates that there's a minimum interest rate that you have to charge before, otherwise it would be considered a gift. Those rates have come down significantly, as you can see here. So for May 2020, if you did a loan, let's say you wanted to hold the mortgage for your child. Instead of them going to a bank, they want to buy a house. You're going to be the mortgage. You're going to be the bank. So you lend them the money. You become the lender. You would only need, because it'd be more than a 9-year term, to charge 1.15%. These interfamily loans are usually lower than they would get from a bank anyways, and then you look at how low this is. So that's the minimum you need to charge. If that doesn't work for your finances and you need to charge more, there'd still be a savings likely for your child, let's say, than they would get from the bank. But, maybe you need to charge 2.5%, I don't know. So let's say they already have a mortgage. You could use this strategy to refinance their mortgage. And again, you have to have the cash, of course, to do all this. But if you are in that position, that can be a great way to help out a family member. And if you can afford the low interest income and you're helping them out, you're seeing the benefits of it. So this is a nice opportune time with the interest rates being so low if you want to take advantage of that. Another technique is called a zeroed out grantor retained annuity trust. With this one, you make a gift to this type of a trust. The trust pays you back an annual annuity payment. This one can be structured where the payment is high enough that the remainder, it zeroes out the gift tax implications. So basically you're getting your principal back plus some interest rate, which we'll talk about. And then at the end of the term, the assets pass on to your heirs. So this doesn't have to be what we call zeroed out. It can be that your payments back to yourself, the annuity payments are lower. So there is some gift implications that you would have a gift tax return or something. But this is what we call a bet to live technique. So I get a little nervous in this environment of relying on this to use some of your estate exclusion. So this can be a great way to freeze your wealth because any growth beyond the interest rate, which for May is 0.8%, will escape transfer tax. So you think of the deflated values we have, the low interest rates, you just have to hurdle all that, let the rebound happen in your heirs' hands. So that can be a very powerful technique, whether it's a regular grantor and retained annuity trust or a zeroed out one. That would depend on your circumstances. There's always annual exclusion gifts. For 2020, actually a couple of years now, they've been at $15,000 per person. So what that means is you can give $15,000 to anybody you choose. That's $30,000 between husband and wife without there being any gift tax implications, just a freebie. So over time, you can imagine if you have multiple children, grandchildren, you can even give to your children's spouses, et cetera. That can be a lot of wealth in a year and then every year. So over time, it can remove a significant amount of wealth from your estate and the future appreciation as well. So in this environment, maybe it makes sense to fulfill these annual exclusion gifts with publicly traded stock that's deflated in value so that you're able to give away more shares, let the rebound happen in their hands. I didn't mention to say here, but maybe now is the time to fund a 529 plan for children or grandchildren. While the values are down, maybe it's a good buy opportunity. So whenever you do this, you always, if you have a federal taxable estate, it's pretty much a slam dunk that gifting publicly traded stock because the state tax savings will outweigh the capital gain implications to your heirs. If you don't have a federal taxable estate, that needs to be looked at before you do that. Because again, income taxes can be more costly than estate tax savings, depending on the situation. So, opportunity is perfect to seize it before it's gone, whether it's values rebounding, interest rates rebounding, or the laws all changing and opportunities going away. So, encourage you all to act now and take care of your own planning. I've included a slide of further resources, various articles that you can read more details about on those tax facts. So thank you all for your time and for attending this webinar. If there's any questions, we'll go to the chat. Let's see, bear with me. I have to go to the chat. I don't see any questions. If you think of anything, our contact information is there. So please, email us, and we'll be happy to answer your questions and see what, how we can help you out. So thank you very much, and please be safe, stay healthy, and have a great day. Thank you.